Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
Here's the one.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital Hacking begins in 3, 2, 1.
Welcome back to the big show, John. It is great to see you. This is Josh McCallen, John Edwin.
Yeah. Oh, we had Dane Czaplicki on our show today. He owns a company called Members Wealth, and they're doing some amazing things. I'm going to let Josh actually talk.
You know what? He's one of those kind of high quality financial planners in the vein of treating people like family offices, really comprehensive advisory services, which is pretty cool. He's going to define that. He's going to explain where he learned and how he went from loving the dogs and veterinary school to loving the bulls and the bears. I mean, he's all about animals, this guy.
And he got to meet his wife at University of Penn, where he went to school. So it was a double win.
Big time win on this show. We're all going to win. Enjoy.
Let's go.
Well, this is exciting. We got Dane on the show. I'm excited, John. Thanks for doing this.
Yeah, and Dane is an incredible guy, and I'm so appreciative specifically to Dane because Luke has been doing an internship with Dane at Members Wealth for the last 6 months, and he comes home every day just learning more about the economy, about finances, and business in general. So, Dane, thank you. Dane, thanks for being on the show. Tell us a little bit more about yourself.
Yeah, absolutely. Well, thanks. And Luke's a great guy. I've probably worked with 60, 70 interns over the last 20, 25 years. I love working with them. And Luke's definitely at the top of the class of those 60 to 65. So
awesome.
Hats off to the job you've done with them. Dane Czaplicki, Members Wealth, as you mentioned, been wealth management like 25 years. But basically, I had a non-traditional start. I didn't grow up around a lot of money. I didn't grow up even focused on finance. I was really a biology major. I went to veterinary school down at University of Pennsylvania and had the good fortune to go, but then I dropped out to chase the finance and investing dream. And it was worth the pit stop. I got to meet my wife down there. She was getting her master's at Penn, and we were working in the same restaurant right on Penn's campus, and a good friend introduced us. And as they say, the rest is history. So, and I've got a lot of good friends and clients from the vet school days. So, and I still love animals, but I didn't want to take care of them for the rest of my life. And I got introduced to investing in finance. Going back, you guys might remember a show called Family Ties with Alex
baby.
Keaton. Yeah, so I was very much into the young Republican money side back watching him on that show, and then got into playing Monopoly was a big influence for me growing up, and learned about real estate, finance, and leveraging and cash flows and rent. Had an interest there. But we didn't have economics and finance classes, so I went the science route, strength and math. And then when I was down at vet school working in that restaurant, I was serving these firms called Morgan Stanley and Goldman Sachs, and they were coming down to recruit kind of the big finance guys out of something called an MBA at something called Wharton. I didn't know what any of that stuff was, but they were serving sushi. I didn't know what that was back then. So it was an introduction to finance and investing, but I fell in love. And that was the peak of the tech bubble, and I was day trading stocks, kind of like kids are doing today. We did it in the late 90s, but we did it on not Reddit boards, but on Yahoo message boards. And then from there, I got more serious about investing, and I started working with some really ultra high net worth families, what you'd say are the billionaires and 500 million and higher. And I learned what long-term preservation of capital was, and tax and estate, and how it all pulled together. And then I ultimately, got promoted up to more senior roles, and we sold a firm that I was at, and I had some time to think about it after we sold, and ultimately wanted to partner with people from my past and launch a firm, Members Wealth. And that brings me to the present. So,
Love it. So, that's a heck of a jump from going into vet school at UPenn into finances, and the story of these wealthy financials people coming into the restaurant and then talking to you about it. And you were already day trading at that time. Where did you start? Like, I understand you own Members Wealth now, but like, what did it look like when you started in finance?
Well, it was not a great start. So yeah, it was 2000, and I got that interest. And when I decided to drop out and pursue it, I don't know if you remember the tech bubble, but it just blew up. So they weren't hiring anybody, let alone vet school dropouts. And so I have to credit my grandmother, God rest her soul. She could talk me up quite a bit, and she was in a pottery class and met a woman that worked at Vanguard. And I got an interview,
Whoa.
and I was the last class hired at Vanguard back in 2000 before they froze hiring for 18 months or something like that. So I got my foot in the door, and luckily I had a boss that told me about the CFA program, which is the Chartered Financial Analyst. It was a self-study. One thing biology and chemistry and physics taught me was how to study. So you throw a few books at me, and I don't want to insult every finance major out there, but I assure you the math's a lot easier than physical chemistry and whatnot. So I jumped right into accounting 1 and 2. I had to take night classes at Westchester to get a foundation in order to study for the CFA. I didn't have to. It wasn't required, but I had to because I didn't know anything. Put myself through that program, and then it started to solidify. One thing Vanguard had, I didn't make it long there, but they had this librarian. She'd walk around with a cart, and she had books. It kind of felt like a prison. And you could check out books, and I read every investment book I could get my hands on. Of course, got introduced to Warren Buffett, value investing, and because day trading lost its luster when the market lost 55% of its value, or the NASDAQ lost even more, I went real deep on fundamental investing instead of day trading. And then I got into what's called manager due diligence. So I spent the better part of my career from probably 04 to present day going around and trying to find the best money managers across asset classes. And I realized early on, I thought I could do better than a lot of these guys. But then I started meeting the creme de la creme, the best money managers around the world that pick stocks, pick real estate, private equity. And once you meet the best, you're humbled. And I realized it would be a much better lifestyle for myself to allocate to the best and try to be the best in every category. And once I kind of swallowed that and digested that, build a career on finding the best investments for our clients, and really, really love that. Now,
That's
ultimately, go ahead.
I didn't mean to interrupt. Keep going, Dane.
Josh is going to chomp it at the bit, but real quick. So a question I have, and yeah, this is awesome information. You were talking about, you were, reading every book you could get your hands on. Could you give us 1 or 2 of those books that you would recommend to people who are just starting to look into it for almost like beginner, easy information to take in?
Yeah, I'm glad you clarified that part. Yeah, there's a lot of text out there from simple to complex. One you hear about all the time that I would say I read every year still. It's Rich Dad Poor Dad. I think everybody's familiar with that. And I go back to read it part because the principles are solid, right? Like I can pick it apart and laugh at certain parts of it, but I think anybody that wants to be around investing, that wants to start with something basic that you can throw to a high schooler, it's a really good start. And that's a little more general than just investing, but it's a good pique your interest. I got headlong real quick into books by Benjamin Graham, who's considered kind of the father of value investing, the grandfather of value investing. He was a mentor to Warren Buffett. He had books like Security Analysis, Intelligent Investor. I read every single book I could get my hands on about Warren Buffett. I read all his quarterly letters, his annual letters. And then from there, got into every book I could on risk, how to help people avoid losing money. And I'm still a really prolific reader today. And one of the big takeaways I have from continuing to read is you're constantly growing. It's a core value of mine, is continue to grow. The more I learn, the more I realize I don't know. And so I can never stop learning. And there's also overlap. So after the first 10 or 15 years of just really, really heavy focus on the investment side, I started to realize I should read non-investment books as well to start to create a mosaic, as they say, or triangulate, because you learn a lot. And having had a background in biology, I went from being raised a Catholic with a creationist mindset to an evolutionist in college, once you're a biologist, and going back and forth in different cultures. I took a lot of anthropology courses studying on human behavior. And when you start thinking about investing, it's so much more than numbers. It's really about humans. And that all parlayed or transitioned into wealth management, which is a service human business. And so you start reading and you just kind of keep peeling those layers back, unraveling that sweater and what interests you. And because I had that insatiable quest or thirst for knowledge, I think I've just become a better investor by broadening out outside of just investing books. So I go back to kind of recommending when people say, where do I start? You got to find that passion. And, a Rich Dad, Poor Dad, or something, a simple book that sparks that interest. Playing Monopoly, right? In the 90s, I would buy informational CDs off the overnight TV infomercials, right, to learn on real estate and investing. And you start taking all that. You just have to have that passion, and you never stop driving. So,
Yeah. Josh, what do you got? I know you were chomping a bit.
Yeah, no, that's awesome. Dane, you definitely spanned a lot of human knowledge there and information. You kind of spanned it from biology, evolution, all the way up to the psyche of the human and why that impacts investing. There was a couple things you said. One, that your first foray into investing as you became a professional is that you wanted to find out, you were the manager, you wanted to do due diligence on the managers of the money, right? So the first firm you worked for, what was the name of that firm? Was it a firm you created?
I left Vanguard and went to a firm called Lockwood Financial.
So at Lockwood, you wanted to find a money manager. You were intent on finding the best money managers, correct?
Correct, yep.
Whereas at Vanguard, what's the difference? They are the money manager? Is there a difference there? Just teaching the audience?
No, actually, Vanguard, most people know Vanguard is like the founder of passive investing, low cost, track the market, pay low fees, tax efficient. Bogle, that was the movement he started. I absolutely drank that when I was there, that Kool-Aid. If you just want market exposure, you don't pay a lot for it, right? You buy an index fund. But a lot of people don't know Vanguard's also one of the largest active money managers in the world too. And they actually run a lot of their mutual funds or their investments. They're managers of managers as well. So it's not always in-house. They go out and they find some of the best small cap international bond managers and then hire them to manage the big pools of capital. And Vanguard's just the distributor in that case. And so I started to understand what that was, but Vanguard back then was almost $1 trillion. Now they're, probably approaching 10 trillion. But when you're that big, you start to get limited from what you can do, right? Yeah. And so when I got to a firm after Lockwood Financial, it was called Veritable. It was ultra high net worth families, kind of like 500 million and higher. And what I learned there was we could write really big checks. And what was nice about that is if I could find a good investment, I could write a check. So it was my job to find the best investments because we had really big checks and it didn't have to be operational, didn't have to be fit for everybody. And what we found was something called capacity constraint. So if you could hire a manager that would limit their growth to say 300 million or 500 million or $1 billion, they could invest in more niche investment opportunities that like a Vanguard couldn't. And so what happened was I really started to understand the polarization in an investment portfolio. If you want low cost and passive, you buy Vanguard, or now there's iShares and ETFs. There's 1,000 of them. You buy really, really low cost. But if you want active and adding tremendous value, you probably want to find the best that has limited their size so they can go in and find those niche opportunities.
Okay.
And once I did that, the rest is history.
Yeah, I mean, we have to kind of live in two worlds here for a second, Dane, because I want to go all the way down to the beginning investor and then back up to where you are as someone who's really thought this through and has a deep. First of all, you're a highly educated young man, but you're more successful than you deserve in your 20s. I'm just kidding. But so, Dane, the part that has always interested us non-Wall Street guys is we call it sausage. It feels like there's a lot of sausage in the world of public markets. Because what I just heard you say was this, and I don't know. You said, so at Vanguard, they do also have active managers. Let's say his name is Bill or her name is Jen. Let's use her name as Jen. So Jen is managing a active fund at Vanguard. She then goes, because it's in a sector, she goes out and finds money managers within that sector that are great. And she's really managing those managers, is what I heard you say. And these managers, these money managers, they exist where? When Jen at Vanguard hires Joey, where's Joey? Is Joey in another? Where's Joey? Like, who's the people that actually make the decisions about what stocks to invest in?
Good question.
If you want to get into the sausage, they can be anywhere, right? So some may actually be within Vanguard, but a lot of them aren't. They might be up in Boston. They might be in San Fran. They might be in Asia. Yeah.
And they're not forward facing at all. No one like you and they do not have retail clients.
Well, that varies too. Some will have a retail presence through their own firm, and others are, solely institutional.
Okay, because where I'm getting at here is the next level for those families that are listening to it, and they're like, man, I really would like someone that can help me get into the public markets with an intelligent strategy. They're sitting here listening, going, well, Dane seems like a fine young fella. We should call Dane. So they're going to call you, Dane. This is Mr. and Mrs. We have some cash over here. They're going to call you, and you're going to sit down and build out a strategy for Mr. and Mrs. Cash. You're going to then go to Joey, who's in that, you're going to place money with Joey because they want that sector. So you're going to skip the Vanguard lady, and you're just going to go place. See, the part that's hard for me to understand is where does Dane fit into that same ecosystem that Vanguard fit into? If you could just kind of flesh it out a little more, paint by numbers for us newbies, if you don't mind.
Sure. So Mr. and Mrs. We have cash, I believe. They have a lot of choices.
They do.
They can go direct to Vanguard, for example, since we're talking about Vanguard. They could go direct to Fidelity, right?
But once they're there, they have a lower quality version of Dane to talk to, don't they? They're going to be talking to somebody.
You said it. I didn't.
Well,
say
Dane,
but,
somebody as handsome as you, we all know you're the best.
So it's a very similar thing to what I was just saying on the money manager side. You go to Vanguard, I'll still say it's of quality service that you can get, but it's for the masses. It's for millions of clients that call in. If you're Mr. and Mrs. We have cash and you want something more than what's offered to millions of people, you want a level of customization, boutique services, family office services, a comprehensive approach. All we've talked about is investing so far. That's about a third of what we do.
Oh, really?
Right? We work on tax, estate, risk, insurance, LLCs, bringing it all together.
Yeah, well, pause there for a second. That definitely would not be what you would get if you called Vanguard's in-house person, because they don't, that's like outside the wall, right? They wouldn't.
I'm not sure about Vanguard, but a lot of firms like a Fidelity, JP Morgan, they might have that. But typically, unless Mr. and Mrs. We have cash or like 50 or 100 million cash and higher, they're probably not getting those types of services. Yep.
And that's where you pride yourself. And that's where you live in this universe. So then sounds like you have family office style services, which you're going to have to define. John's not going to let you get off the show without you defining that. But let's say you've gotten through interviews, spent time with Mr. and Mrs. We have some cash. You're then going to say, why don't we take this X number of dollars? We'll place it in this area. We'll place it in that area. We'll get it active, right? That is going to be part of what you do for them, right?
Correct. Yep.
In that, how much of that are you going to put into the public markets or alternatives? Or are you just going to stay public with that family or with most families?
Hi, this is Melanie McCallen. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com.
Hey, it's Hal Elrod, author of The Miracle Morning, and you're listening to Capital Hacking. Enjoy.
Yeah, so one of the things we can do is we can build a custom portfolio for our families. It's not a model. It's not a one size fits all. And so I was humbled, I should say, about 15 years ago, that even though I think academically and with my experience, I can build the absolute best portfolio, that best portfolio might not be right for Mr. and Mrs. We Have Cash. So I have to really understand what it is that they're comfortable with, what they're trying to accomplish. And so as a direct answer to your question, it depends. So I have clients that have all public markets and clients that also have a blend of public and private. I have clients that have all traditional investments, and I have clients that have traditional plus a blend of alternative investments. And the way we've set our firm up is I'm indifferent. We're paid one way by the family. So I'm indifferent as to whether they're aggressive, conservative, public, private. Doesn't make a difference. They're paying me the same amount. So my only job is really to help them get to their goals based on their comfort levels, their education levels, their knowledge, their experience, their desires, their willingness, their ability to take risks. A lot of our families might already come and they might be worth, say, 100 million, but 75 of that's tied up in illiquid business, right? So they might not want anything to do with illiquidity when they come here. Whereas I might have another family that's all liquid and they're going, can I get some of that illiquid private equity stuff? And so they're two totally different situations and we can handle both. And that's what you can do when you have a custom boutique firm versus Vanguard. You go in and it's kind of, you got to throw them in.
Okay, I love it. You're killing it. So we definitely want you to explain in a very simple way what a family office is. That's one. And then also I want to get into a little bit of the elections and your forecast for the economy and where you see that going. And so I want to take it there. But let's start with the family. What is a family office?
Yeah, the family office is, I think, easiest to explain. Most people know big famous names from the past, like the Carnegies, the Rockefellers, right? They were great at making money. And then they were great at losing it out the back door to snake oil salesmen, fraud, tax, people that didn't have their interest in mind, but were clamoring for their capital, right? And so they just stood up at one point and said, you know what? We need somebody that works for us on our staff that has our interests aligned. And so they hired tax, legal, and investment professionals in-house and created their own internal investment office, their own family office, right? But that's pretty expensive, right? You got to have a lot of money to hire all those great people and run that in-house. And all the wealthy families today do that. And not, usually it's like billion and higher type of thing if you're going to run a single family office. Somewhere along the way, a few families said, you know what? That single family office thing sounds great, but what if 5 of us got together because we're each worth 200, 300, 400 million and aggregated resources and still had a staff that worked for 5 families instead of 1? And then you got this idea of multi-family office. And once I understood what the multi-family office did, I wanted to create that environment, which is as conflict-free as possible, where we get paid by the families. So we have the family's interest first. And then bring it down to, I'd say, a reasonable level. Let's say 1 to 100 million, right? So families that otherwise would be ignored by some of the larger firms or the larger multifamily office. I believe everybody deserves to have a financial plan, right? And Vanguard does a great job of helping folks get started, right? A lot of our clients may have come from Vanguard or wherever and been do-it-yourselfers up to a point. But then things get complicated. Right? They're super successful. They're super busy. All of a sudden, they're getting liquidity from their business. They sold a piece of real estate. They got an inheritance. Their equity comp at work's getting very complicated. Whatever it is, they get to the point they don't want to do it themselves. And then they hire us. and we bring multifamily office services to them. And then they call about the election.
Yes.
They'll call before the election, and they'll say, "Well, what it depends on what side they were on. Our clients are split like the country's split, right? We don't have all Republicans, all Democrats. We got a few independents even, and so you throw that whole mix, and we run, we have to run down the middle as we talk to them. But whether it's an election or really any other big event that occurs from time to time, COVID, 9/11, wars, right? We've had all these things over the last 30 years, and one thing remains basically true, right? If you've built up and have written a plan and you have a good plan and a good team to work with you, you should already know what you're going to do regardless of the outcome or regardless of when these events occur. And so you have to talk some folks off the ledge before the election and some off the ledge after the election. That you do, right? And because the goal isn't so much the short term, it's taking advantage of the volatility that these events cause. And there's a lot of people that thought markets would go down after this election. They were wrong. They went straight up, right? Interest rates also went up. Jeremy Siegel, a lot of people follow him. He's a Wharton guy. Talks quite a bit about the economy. I have to agree. He just said, Trump is the most pro-market president we've probably ever seen in U.S. history. So he measures himself really based on the market. That's his yardstick. And so take him for what he's worth. I mean, he says, I want to make the economy better. Whether you like him or not, it doesn't really matter. What he's trying to do is make the economy better. So you might not agree with the agendas and his leanings or trust him. It doesn't make a difference if you start looking at your portfolio. At least last week, things went up. And so as we look out, we do have a playbook. He was a president before for 4 years. We kind of know what he did. He's going to do some things the same, some things a little different. But as a market person, you have to lean and start to think things will get better. It doesn't mean there won't be volatility. Interest rates we're watching closely, right? Rates have gone up. They could continue to go up. Rates are usually closely tied to inflation. I don't think that's a done deal, though. I think a lot of people think rates have to go up because Trump's policies will be inflationary. I think, like anything, it's a wait and see. But we're positioning our clients appropriately for that.
All right, so let's talk about the hot topic right now, the really hot topic, Bitcoin. What are your thoughts on Bitcoin? Are you investing in Bitcoin? Do you recommend that for clients? And based upon their wealth, what percentage? So let's put that out there on the table.
Yeah, so I'll be the first to admit that I heard about Bitcoin was at $100, $400, and $800 a share, and I didn't buy any. So shame on me, I guess. We do have clients that own it. We do help them size it accordingly. I have to say that it doesn't necessarily fit what my definition of an investment is, meaning it doesn't produce cash flows. There's no way that it will ever really produce cash flows.
Yeah,
right?
I got it.
And so the only way you make money on something like Bitcoin is for the price to go up. And that's tough to define in my head, the way I think about investing as an investment. And so it's not really too different than, say, like art or wine or bourbon, right? Like these are things that can go up in price. There's a maybe not great name, it's greater fool theory. It's you got to find a fool that's willing to pay a higher price than you did, right? And so when I'm managing, up on my sign, preserves number one. So a lot of our families come to us with having created wealth, and we have to think about preservation. And with something like crypto or Bitcoin, the preservation principles aren't there. I understand the arguments. I see how it works. I won't tell a client not to buy it if they want to buy it. But it's a tough one to say it's an investment from my perspective.
I'll tell you, it's been fun. It's been fun digging in on this. I think you answered that as honestly as you feel comfortable doing. And you talk about preserve as your number one priority. How much of, I imagine people say they want cash flow sometimes. The people who have invested properly that are coming to you. This is the conundrum. The middle class, you're talking a little bit above the normal middle class with the size of money you're talking about. The middle class has been told, put all your money away, put them in retirement, and let it sit there and grow, and don't ever touch the principal. When you retire, live off the proceeds of the principal, correct? That's like the basic philosophy of investing for the middle class, would you say, Dane?
You hear that quite a bit, yes.
Yeah. What is it when you're of a family office level? Is it the same exact principle?
Yeah, I'll go back to it depends, and it's customized to the family. We have families that you've probably read a book called Die with Zero. We have families that want to stiff the undertaker. They want to spend all their money while they're alive, give it away. We have others that want to create legacy trusts that endure for generations to come. And that's not my call. That's the family's call. We can work under both outcomes and everything in between. It's a bit different. Even for the middle class or people with, say, 200,000 and 2 million, if you have those proceeds, there is a mindset, and I understand it from a behavioral standpoint, that you want to protect your principal and only live off the dividends. Say, when you actually look at cash flows and lifespan, that's not necessarily what you should do. I mean, you can spend down your principal because you're going to die. So there's an element of do you want to? And we don't know the day you're going to die, so it's hard. And this is where all the human behavior and actually what's grown to be, to me, the fun and interesting and challenging part of our industry, more so than the investments themselves, is getting your hands around family and individual behavior and dealing with that. So it's a good question. It's very nuanced, and we could do a couple shows on that one. So
it's awesome.
Glad to have you back.
Yeah. And so Dane, as we wind down, if our listeners want to connect with you, if they're interested or if they want to invest, whatever it is, where do they find you?
Sure. My email is simple. It's just Dane, DANE, at memberswealthllc.com. We have a website. It's memberswealthllc.com. Feel free to give me a call. The office number is 267-367-5453. You can reach out to John and Josh. They know where to find me as well.
Awesome.
We appreciate you, Dane. Thank you very much.
Thanks so much.
Thank you for the time, guys.
Cheers.
Damn straight. We just got we got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.